Hockey nut, and hockey season is almost upon us yet again. And I know what's going to happen soon after today's show. I'm going to get all my razzing from my buddies from Montreal and Boston and Buffalo and Tampa Bay. So you go ahead and just send me all your commentary on your teams, and we'll see what happens this year. All right. So anyway, we're going to get on with today's show. And listen, before we get started here today, I'm going to go a little bit quick because I got a lot of content today. So let's get started. So we're going to cover today vaccine update, labor, tax changes, mega IRAs. This is a new one on the front, housing, stock market, inflation, and my econ map version 7, which has not changed for going on almost 10 months. So the good news is we got about 208 million first doses out the door as of September 10th. Third dose is not approved yet, but we're seeing some statistics about the efficacy of the vaccine over age 75 drops to about 75%, whereas the efficacy at people under 75 is still up about 95%, and it looks like that booster shot will probably get put through. It's not approved yet by the FDA, no matter what the White House says, so that's in the process. Now, a big part of what we're going to cover today is the Delta and I'm not even sure if I'm saying this right or not, the MU or whatever it is, the variant that's coming off the Corona-19 virus. All right, so let's talk about unemployment. Well, here's an easy chart. A lot of people have written in and said, hey, Ken, I don't really understand what the difference between, new unemployment claims, existing unemployment, farm, non-farm payrolls. So I'm going to make it a little simpler from here going forward. And as you can see, in April, we were at 6.1% unemployment for men over 20 years old. And now we're down to 5.4. The numbers are still that we have about 10 million jobs available with 9 million people still unemployed. So something's fishy, on the dock here. So obviously there's still a lot of people that just don't want to return to work. There is the news that a fourth stimulus check will be coming out. However, here's the good news about it. Bad news is it's even more taxation down the line, but the good news is it will only be available to those people that are 62 or 65, they haven't decided yet, or older, that are living on Social Security. And honestly, those people are probably the people who need it the most. All right. So we are still in this flash inflationary period of time, and that has a lot to do with the labor, and it also has to do with just the backlog and the shutdowns. I mean, with this variant that shut down Vietnam, it shut down Malaysia. There's a giant port in China that got shut down. That is what is causing all of this flash inflation. This is what's going to cause over a huge increase in Social Security this year. But it's also is going to affect what's going to happen with interest rates. And then interest rates will then trigger onto more taxation because of the amount of money that people are paid, the amount of money that they have to raise in taxes. So, it's interesting because, I've talked to a bunch of people about this, and I've talked to people that are in restaurants. And I talked to a person that thought that she deserved $50,000 a year for working at Chipotle. And what they don't understand, and because they don't teach us in school, is that's not the way economics work. If the entire low-income force goes on strike and forces a higher payroll, where do you think that that's going to come from? Do you think it's just going to come from the wealthy people? It's such a small percentage. It's going to come from the middle class and the lower income people. So those people demanding a much higher income, they're going to pay more in rent, they're going to pay more in food, more in gas, more insurance, more in automobiles, more in everything else. And unfortunately, in every single time that this has happened, not just in our country, in history, those people actually lose their standard of living. They had a better standard of living when prices were lower and they were making a moderate wage. But when they demand that higher wage, it doesn't work out so well for them. So there's not much you can do. You're talking about something here that basically there is absolutely no way to affect or convince an entire population that they shouldn't do it. Why? Because it's all individually centered. That individual goes to work and says, I need to make 50 grand a year. Well, they don't need to make 50 grand a year. They want to make 50 grand a year. They've built their lifestyle to have to demand that kind of money, but it doesn't work out. So let's talk about taxes and how the government is not only going to pay for this $7 trillion that they've handed out during the coronavirus, but in addition, the other $3.5 trillion that they're planning on instituting for this, and it's already passed. They're just planning on spending the money. How are they going to raise the money for that? Well, the proposal is that they do away with capital gains tax treatment, and they increase that tax rate from 15 and respectively 20% up to the regular income tax rate. Now, they've talked about some limits that they're going to put on that, but nothing is in stone yet. And they're also talking about removing the 1031 exchange. We're putting a limit on that. And they're also talking about getting rid of the step-up in basis so that when we pass away and we pass assets down to kids, now under the current law, all of those gains are forgiven. So there's no tax to the beneficiaries. But under this new proposal, the kids will pay ordinary income tax. Now, there's been a recent proposal, that said that they'll be allowed to spread the tax out over 10 to 15 years. But wait until you see. I don't, listen, when they propose that at the beginning, it's just to inch it in. This is what they've done I've been doing this now going on 40 years, and this is the way they operate. They inch it in. What's that old saying? It's a slippery slope. They inch it in, and then once they get acceptance at 15 years, then they back it down to 10, then they back it down to 5. And you're going to see what I'm talking about here with the mega IRAs. So mega IRAs. So, years ago, I had talked about over and over again, do not go into the cave of the devil. And the cave of the devil is too much in retirement plans. I have been talking about this for 30 years, that I never trusted adding too much money to retirement plans. And here we go. The proposal is if you have at least $5 million. Now, 30 years ago, $5 million was a lot of money, right? That was a ton of money. But now if you have $5 million in a retirement plan, after tax, that's only about $3 million. And I know that sounds ridiculous when you say only $3 million. But if you think about it, $3 million at a 5% rate of return pays $150,000 a year. After your tax, you got $100,000 a year. Today, to live at $100,000 a year, you're not wealthy. I'm sorry to tell you, you're not wealthy. And now what they want to do is they want to tax a mega IRA. So they have not defined that they're going to go into the pension world. And this is good, okay? This is good. They're talking about individual retirement plans. So they want a proposal to accelerate RMDs for the excess over $5 million. And the proposals are to move that excess down to a 10-year RMD, and then a 10-year RMD is already in place under the Secure Act. They're also talking about reducing the age. So anything, basically, you could be 35 years old. And they cite the owner of PayPal. And the owner of PayPal has something like $1 billion in his Roth because he added money to his Roth way back in 1999, and it's just grown to $1 billion. And they're all up in arms that this guy has $1 billion, even though it's 30 years later or whatever it is, in his Roth because they can't tax it. So they're looking at what's called cap acceleration, meaning that once it gets to a certain amount, they want to accelerate the actual provision, the distribution. The Democrats are citing, but the average retirement person has $39,000. And they claim, well, this is unfair. And they're saying, look, 28,600 people have IRAs over 5 million. And there's over 1 million people that have more than 5 million in their pension plans. Here, let me just cite some frustration. Listen, you don't just get $5 million in your IRA. I'm sorry, maybe 1% of the people do, right? But you don't just, this money comes from heaven. Listen, the people that accumulate money in this country, right? They are the people that work hard. They're the people that save. They're the people that hire financial planners to help them get ahead. They're the people that minimize their risk. They're the people that say, Starbucks at $5 or $8 versus McDonald's at 99 cents. They might do that throughout their whole life. So the most frustrating thing to me is when any politician, I don't care what side of the aisle you stand on, or it doesn't matter. Politicians are politicians. They see a pot of money, and this is what I've tried to warn people about for decades. They see a bucket of money, and they're like, let's go spend some money. And where are we going to get the money to spend that money? Oh, look at all these people that retired. And all we have to do is prose it in the right way to the public. Oh, it's unfair. Look at all these rich people. Well, you don't just get rich by happenstance. It doesn't just happen. There's things that you do to get there. You take maybe more risk by owning a business. You sacrifice. You give up time with family. There's sacrifices to that. So in what world, other than maybe living in Europe or living in Russia, is it fair that you create these sacrifices and then somebody says, yeah, you got too much money. You got to take some of that back and give it to the people that didn't sacrifice. Anyway, we've got to all just understand this is the environment that we're getting back to. It hasn't been this way for about 18 years, but boy, we're getting back there. And if you've sacrificed, if you've given up, if you've saved money, you got to work on your plan. You got to work on your planning. Listen, your safety and your preservation of your money doesn't also just happen. That's why there's financial planners and tax planners in this world to work and collaborate with you to make sure, because unless you want to become a tax expert and a financial expert and a global economic expert and build all the algorithms and figure it all out, which very few people can do, I can't even do it. That's why I got to surround myself with a whole bunch of smarter people than me so we can all come up with one collective plan. But that's how you protect your assets, all right? Social Security. Social Security is anticipated to increase about 6.5% this year. Highest increase was 5.8% back in 2009, and it's a lot to do with this flash inflation. Okay, jumping over from Social Security back to, and I probably should have arranged these a little bit differently, but here we are. And so TD and Schwab announces a profit-sharing plan change. Now, many of you, we have set up LLCs and we have set up profit-sharing plans inside those LLCs primarily for asset protection purposes. And, it was nice because I would tell people, listen, years before TD Ameritrade was around, we would have to charge a client $1,000, $2,000, depending upon the situation, to draft a profit-sharing plan. And then we would have to send that to the IRS. It was a big deal. And then profit-sharing plans, TD Ameritrade primarily, came up with what they call a prototype plan. A prototype plan is a plan that they pre-approve with the IRS, and we were able to open profit-sharing plans for people with no money at all. Zero cost of legal document drafting, which is wonderful. And people said, well, how long is this going to last? I said, I have no idea, but we're going to utilize it as long as we can. Well, here comes the change. September 30th of this year, with the merger of TD Ameritrade and Schwab, they're going to do away with new profit-sharing plans. Now, they promise that they will continue to allow you to maintain your existing profit-sharing plan and all of the benefits of it, but they just will not issue any new ones. And Schwab never did. You had to pay to bring in an outside profit-sharing plan, and so that's why we always set them up at TD Ameritrade. So first question is, why a profit-sharing plan? Well, number one is asset protection if you set it up correctly. Because if you have an IRA, there is tongue-tied, awkward moment. There is limited asset protection. Got that one out. There's limited asset protection depending upon what the state is that you live in. And what a lot of people don't understand is they think, well, my IRA is protected. Depends on what state you live in. Some states, like as an example, Nevada has a $500,000 limit on IRAs if you get into a civil lawsuit. However, if you go and dig in there, there's a number of different cases in the last few years where the judge has granted it because of circumstances. So don't take this idea that your IRA is just normally protected. I remember working in Florida and I had a physician that came in and hired me in Sarasota. And I said, you just moved here? Yeah, why'd you move here? Because the state of Virginia took every dime that I had. I'm starting all over again. He was involved in a malpractice suit. They won. His insurance covered so much. And the state of Virginia allowed that patient to take every other dime that he had. House, IRA, everything. He started all over again in his mid-50s, which is really disappointing. So again, just because you think that your IRA is protected, you got to look at the state laws. And then also remember that whatever the state's protection is does not necessarily protect you from any federal confiscation. And that is the IRS or bankruptcy, because those are bankruptcies handled under federal court, not under state court. So even if you go online, you go, hey, my IRA is protected up to whatever it is, $1 million. Keep in mind, IRS can get it and a bankruptcy can get it. And a bankruptcy can get it because if you're sued by other means for other things, like a car accident, and your insurance only covers you for $300,000, but you got to pay out $2 million, you might decide to claim bankruptcy, right? Well, bankruptcy, they're going to bring your IRA in. Even though you think that that IRA is protected under your state, they can bring it back in. One of the other benefits of a profit-sharing loan or the profit-sharing plan is that you can take a profit-sharing loan. You cannot take loans on a IRA. That is a prohibited transaction, and it would cause income tax as soon as you took it out. Here's the best benefit of that loan. In normal loan terms, we borrow money from a bank. We borrow 50 grand from a bank. You know, if it's 5% interest, we're giving the bank the $2,500 a year of interest. If we borrow $50,000 from our profit sharing plan and we pay 5% interest, that 5% interest goes back to your plan. Doesn't go to a bank, doesn't go to a financial institution. It's paid back to your own plan. That's the huge benefit of a profit sharing plan. The other benefit is you can buy life insurance with tax deductible dollars. So if I have a profit sharing plan up to certain limits, and the certain number of years that you have owned that account, you can actually pay for your life insurance with tax deductible dollars. What's the beauty of that? You're paying the premium with tax deductible dollars, and when you die, the death benefit comes to your beneficiaries tax-free. That's the way to hedge the system. Now, and you cannot do that with an IRA. Also, if you add on a long-term care rider to your life insurance, and you pay for your life insurance through your profit-sharing plan, essentially what you're doing is you're getting another tax deduction on your long-term care insurance. And remember, most people say, well, I'm already deducting my long-term care insurance. I probably bet you pennies to dollars that you're not. And the reason is that when you try to deduct any healthcare expense, including long-term care premiums, you have to first exceed 7.5% of your actual adjusted gross income. So here's the way to look at it. Let's say you're paying $5 grand a year for your long-term care insurance, but your adjusted gross income is $100,000. The first $7,500 is not deductible, which means, yes, you are putting the premiums that you pay for the long-term care insurance on your tax return, but it does not result in an actual tax deduction. So technically, you might be thinking, I'm deducting it. You're putting it on the tax return, but it's not providing any benefit. And anytime you try to put a healthcare benefit on your tax return, on your personal 1040, you cannot deduct that first 7.5%, which is one of the reasons why we look at things like HSAs, HRAs, cost-sharing benefit plans that you pay through your LLC or your profit-sharing plan based on limitations. All right, let's jump into the Roaring 20s playbook, right? You keep hearing me say this over and over again. The virus hits the world. We go on lockdown. Same thing as the 1920s. The pandemic fatigue hits, and all of a sudden, the spending spree hits. I got some news for you, ladies and gentlemen. Last week, I stated that there was $2.2 trillion that has been saved and accumulated. A recent study as of this week shows that there's actually $3.9 trillion that has been banked during the pandemic. We are getting to some serious, serious numbers. Now, before it said there's $4.2 trillion sitting on the sidelines. Now the estimates are 5.4 to 5.7 trillion because of the 3.9 that was banked during the virus. So now we're getting to the point where when this supply chain opens up and travel opens up and cruise lines open up and we can travel freely and not worry about the Delta virus and the Mu virus or whatever, the MU virus, if I'm saying that wrong. Listen, what's going to happen is we're going to see a massive, massive increase in the stock market. So we got to be prepared. In the 1920s, what happened was they went on this massive spending spree, and when the money ran out, then they started going into debt. When they went into debt, they went into the stock market to try to gamble their way out of debt. And we all know how that worked. It didn't go so well. All these market predictions of the market crash, I have failed to see where that calculation and that algorithm comes into play. Will we have market volatility? Of course we are going to have market volatility. That's a function of being a part of that market. But a market crash to me is something like 1929. It's something like 2008 or 1999 with the tech market, which took 15 years to recover. I'm not seeing that anywhere close on the horizon. Maybe next summer, right? Maybe next summer, the end of the second quarter next year, if the supply chain gets mended. But all of that is based upon this Delta virus and it opening up. And I also want to bring up something. In the 1929 crash and the ensuing depression that happened after that, There were more millionaires minted during that period of time per capita than any other time in history. So listen, when things get bad, if you know what you're doing or you have people that know what they're doing, this is where you can really capitalize. Let's jump over to the stock market. Well, as of yesterday, this is actually close of yesterday, the market is, the S&P 500 is actually up 21.62% year to date. Now, again, it's going to be a little bit higher because we're only 10 months in. So it's more like 24 to 25% if we annualize things in the way that we all think about things year by year, right? Because we're only 10 months in. So we're not doing too bad on the stock market. Hey, I want to throw one more thing in here. I'm going to bring this up because most of you are repeat listeners and watchers of this show. And you know that we have talked about this, what I call the circle of opportunity with real estate. Well, the most recent numbers of, as of this week that you're watching this is September 10th, is now there are 1.6 million properties in forbearance, down from 7 million at the high of April 2020. Now, estimates are out of that 1.6 million, there's 800,000 to 900,000 that will physically foreclose. The other ones have the cash. They can pay it. They're just waiting until the last minute. Now, to put this in perspective, in 2008, there was 1.6 million mortgages that foreclosed that sent us into a massive depression. Now, again, there's some people out there that say, well, you know, this isn't really going to happen like that because people have equity in their houses. Listen, if your house is in forbearance and you truly cannot afford to pay it, it's still going to possibly foreclose. But you got to remember what happens. You can't just say, well, I could just sell my house for the equity, because the minute you pour a ton of supply into the real estate market, your equity is not necessarily there, because now you're competing against a whole bunch of other people and the prices come down. So when you read this stuff online that says, yeah, but people have equity, that's equity as it stands today. That's not equity after 800,000 houses hit the market and dilute the actual supply that's out there. So let's keep that in mind. I'm still on track with my original predictions with the tax law changes, how they affect the stock market. And again, this is going back. This has been the same econ map that you've been watching from me since January, February. I'm still predicting the market's going to go way up. And then next summer, mid next year, when some of that money starts running out. Now, the only way I'm going to extend this period is if the Delta and the Mu virus, again, apologies if I'm saying that incorrectly, if they stay prevalent and we start to see a supply chain disruption lasting longer than what I anticipated. If it lasts into January and February, we're going to push that further. Because again, it's this balancing act between the cash sitting on the side and the ability to buy products that people want. Right now, there's a lot of money on the sidelines and no way to spend it. But as soon as that spending comes up, the ability to buy products and services and travel, the cash on the sidelines will come down. And that's the critical time that we have to look at on that bell curve. Again, those are the algorithms that I built on the backside to measure those things and monitor those things. And in my opinion, we're not even anywhere close to that occurring. So, actions to take right now. I would suggest if you're going to take advantage of this TD Ameritrade free profit sharing plan, do it before September 30th, because then you have to pay to get a profit sharing plan set up. Consider how you might be paying for your life insurance, and consider converting your life insurance into a profit sharing plan to get the deduction. And the same thing with your long-term care. I can't pound the drum any more than this on the refinance, right? Get it done now, please, before rates do go up and the value and the equity drop. Cash up for real estate. Now, again, I'm going to throw the disclosure in there. I'm not suggesting that you sit on a pile of cash. I believe that the market has a good potential for rate of return in the next 3, 6, 9 months. So don't be sitting on cash. Get it invested, but have the ability, either have the ability to loan against your stock account, loan against your profit sharing plan, take a loan for home equity against your current residence. Have the ability that if the market, the real estate market does what I think it's going to do, you can jump back in. That's the time to start buying second homes, vacation homes, rental properties, etc. I'm going to beat the drum again on reverse mortgages. Sorry, if you don't feel comfortable with this, make that decision between emotion and math, right? Emotion and math. That's always what controls people. Their prior inconsistent and misunderstandings on reverse mortgages has prevented a lot of people from taking advantage of them. I'm a believer in them. Listen, I want to disclose to you. I don't sell them. I don't promote them. I couldn't even tell you who the best company to get it through is. I get no referral fee, no commission, no affiliate fee, no nothing. I'm telling you because when I do the math on a reverse mortgage, it just makes sense to do it. So investigate it for yourself. Finally, we have to start thinking differently about kids. We have to start thinking differently that we have to start moving assets strategically from your generation to the next or the next after that generation, because these new tax laws that are coming down the pike stand to take 30, 40, 50, 60, depending on where you live. You live in California and New York, they could take 75% of your assets to pass them down. So you got to plan. Again, don't look at just your plan as, hey, this is just my family. Look at it as you, your kids, your grandkids. Because the bottom line is, if you have enough to survive and you have enough to sustain the way you want to live, now you got to start thinking about how am I going to pass that down to the next generation in the most tax efficient process possible. Don't think, hey, whatever they get, right? That is like financial suicide thinking, because you're basically going, I don't care what the government takes. That's my kid's problem. Listen, you didn't work this hard to get where you got just to give it all back or give half of it back. Consider the planning aspects of this. Hey, I got a new introduction for you. I set up I had it set up for a little while, but I am going to go ahead and branch off and create a separate YouTube channel. Here's the reason why. I set up Wiser Retire so that people would have a different view. H&H Retirement Design and Management is really designed for high net worth people. Those people that have sizable sums of money that are really interested in protecting, preserving, and trying to strive for the best possible financial outcome. But H&H Retirement Design and Management does not take on all clients. We're very selective about the clients, and there's certain minimums that we have to have in order to work with you. However, I did set up Wiser Retire because I want this message to get out to you if you don't have a high net worth, your kids, your grandkids. And so here's what I did. I created a separate YouTube channel. I'm going to start creating content that is not so high net worth focused, but it's focused more on accumulation. You've heard me talk about this over and over again. There's two phases in your life, the accumulation stage and the distribution stage. So look at it like this. H&H Retirement Design and Management is really designed for that distribution phase of your life. Planning out how to get income, planning out how to preserve that tax. I set up Wiser Retire because we're getting a lot of children as clients. And I don't want to tell my client, no, I'm not willing to take your child on because I don't have money. So now we're setting up Wiser Retire. So what you could do is you could Google it, just say Wiser Retire Money, Wiser Money Channel on YouTube, and you'll find this. This will be the home page. So if you see this, you know you're on the right page. You can subscribe to this or send it to your kids to subscribe to, okay? If you have not joined the H&H Retirement Design and Management YouTube, all you got to do is just Google H&H Retirement on YouTube. You'll find this page, hit subscribe. This way, what will happen is you'll get notified because I'm going to start creating a lot more specific content. As we get closer to the end of the year, this one time a week thing that I'm doing to try to inform everybody, I'd love to get into the grain with you and into the weeds with you, but I don't have the time to do it on one show. We're going to have to talk about capital gains tax. We're going to have to talk about how you adjust your trust, your healthcare power of attorneys, all these little things. And I'm going to be producing a lot more content on a more regular basis to help keep you informed. This is why it's important that you and your children join those two web page or those two YouTube channels, so you'll be notified when I actually do those YouTube videos. Anyway, to close up for today, if you've got any questions, give me a call. It's 844-702-1040. I shouldn't say that. Give the team a call. You know, there's 18 of us there that can help you and make sure that you're doing the right things. Hey, with that in mind, have a great weekend, and I hope this helped you today.